Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at some results from the manufacturing 1 and 2 sectors, and we're focusing on Trinidad Cement Limited, or TCL, as well as the West Indian Tobacco Company, or WITCO, or WCO for short. Now, both groups would have reported differing outcomes in terms of their financial performance. Let's take a look at what would have transpired and what investors might expect in the coming months ahead. Turning firstly to TCL, for their 9-month period ended September 2023, the group would have reported an earnings per share figure of 32 cents, which is a 3.2% improvement from the 31 cents recorded in that prior comparable period of 2022. Revenues were up impressively 9.6% odd from 1.55 billion to just about 1.7 odd billion on increasing sales volumes as well as some price adjustments. Gross profits up 1.9% from 533 million to 543 million. Of course, cost of sales increasing in a certainly inflationary environment over the past several months. Other expenses also up 34.6% from 35.4 million to just under 48 million. Overall, however, net income attributable to equity holders did improve just about 1.3% from 167 million to just about 169 odd million. Now, when we take a look at the revenue story for TCL, we can see that it has been positive and trending upward over the past 4 comparable periods, moving from that very heavily COVID-affected period of the 9 months of 2020 at 1.25 odd billion, moving to that 1.7 odd billion in the most recently concluded financial period, with a roughly 10% increase in their cement sales, which accounts for well over 90% of overall revenues, moving from 1.517 billion to just over 1.67 billion. Of course, there was some marginal decline in its concrete segment, of course, a much smaller contribution to overall revenues for TCL from 40 million to just about 30 million, but definitely in the right direction in terms of revenues for TCL, positive and upward trending. When we take a look at the margin story, however, it's a little bit different. There hasn't been any particularly concrete trends in terms of TCL's operating and profit before tax margins. We can see it bouncing around quite a bit. And in the 9-month period of 2022, for example, its profit before tax margin was just around 15.8%. That has since declined to about 13.4% in the most recently concluded period of 9-month 2023. Operating profit margin as well also declining from 17.7% to 15.5%, meaning that for every dollar of revenues generated, less and less of it is being converted into profits, at least in that most recently concluded period. So, of course, inflation and inflationary pressures playing a significant role in that regard. Hopefully, TCL can clean it around in subsequent periods. Now, at a price of $2.92, TCL is still in the red in terms of its trailing 12-month earnings and has not declared a dividend for quite some time, so there's no dividend yield on a 12-month basis. So with revenue growth in mind, but of course keeping an eye on margin volatility and that absence of dividend income for the time being, Bourse is going to maintain a market weight rating on TCL. Turning very quickly to the West Indian Tobacco Company Limited, or WITCO, the group would have reported earnings per share of 59 cents for the 9-month period of 2023. Compared to 83 cents in the prior comparable period, a decline of just around 29%. Now, the revenues over that 9-month period also declining 14.6% from 549 odd million to 468.6 million. Of course, that is one of the major concerns of WITCO shareholders and prospective investors. Gross profits also declining 24.2% from 389.8 million to 295.3 million. Overall profits for the period declining that 20.3% from 208 million to just about 149.5 million. So certainly not the best of reading for investors or shareholders in WITCO at this particular point. And we can see on an extended period that there has continued to be revenue challenges for the company. Most recently, in that 9-month period, having declined consistently from that 9-month 2019 of just around 700 million in revenues to the current level of 469 million. Of course, increased competitive pressures, substitute products, and other taxes and excises certainly playing a role in terms of that reduced revenue. However, on a comparable quarter basis, we can see that decline in revenue has appeared to have been somewhat arrested, falling just about 1.3% from 165 million in that third quarter of 2022 to 162 million in the most recently concluded period of the third quarter of 2023. So perhaps a silver lining and some hope of increased revenue or stabilization at the very least of revenue for Whitco going forward. On the margin side of things, well, again, not the best of stories. We can see that after being the role model in terms of stability of margins for quite some time, you can see that since the 9-month period of 2021, those margins have continued to decline. Again, inflationary pressures as well as slow top line reduction with some degree of fixed costs playing that role in that contraction of operating gross profit and profit after tax margins. So just as an example, at the 9-month period of 2021, the profit after tax margins were just about 44%. That has since declined into 9-month 2023 of just about 32%. So again, not being able to convert every dollar of revenue into as much profit before or profit after tax rather for Whitco. That has been a trend that investors have been observing over the past couple quarters since 2021. Now, in terms of dividends and earnings, we can see that earnings in that blue column has also declined, and with it has come a decline in dividends. The payout ratio for Whitco continues to be in the high 80s at 88.1% at the 9-month period. However, that dividend per share for the year to date has just been around 52 cents compared to around 72 cents in the 9-month period of 2022. So at a price of $10.29, Whitco has fallen just about 50% year to date. So some more pain for investors in the short term, and is trading at a price earnings ratio of around 12.9 times compared to the sector average of 13.4 times now, and offers investors currently a dividend yield of 7.6%. But again, take that with a pinch of salt because there may be further adjustments to dividends paid based on earnings performance, of course. And that is 7.6% does look quite attractive rather to the sector average of 3.4%. So with those revenue challenges in mind and narrowing margins, but looking at that attractive dividend yield based on your outlook for Whitco and overall relatively attractive valuations, Bourse is maintaining a market weight rating on Whitco for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse, email us at invest@boursefinancial.com. And of course, you can check out our website where all of our research is absolutely free at bourseinvestment.com. Stay safe. Have a great investing week. Enjoy your Diwali holiday, and we'll see you next time on the Bourse Report.